Welcome to Friday Takeaway. The IMF's Christine Lagarde is in the papers for saying at the World Economic Forum in Davos early this week that it's the broadest synchronized global growth upsurge since 2010. Now, the US government has reopened this week after Congress approved funding for another 3 weeks and ending a 3-day-old government shutdown that happened because they missed the deadline to agree a spending bill. As widely expected, Bank Negara hiked interest rates by 25 basis points this week, saying they were part of a normalization plan and a preemptive move before the dangers of overly cheap money reared its head. Bank Negara were quick to point out, though, that interest rates remain accommodative. On to the FBM KLCI. As at 10 a.m, the index was up marginally to 1,847 points, 1% higher than last Friday's closing. Year to date, though, the KLCI is up over 2%. So next up, some big weekly movers. Gamuda Berhad. Market cap 13 billion ringgit, they are one of the country's largest engineering, property and infrastructure companies, having built MRT1, MRT2 and the LRT. Now, Gamuda, it seems, is not happy with just one mega project because they've tendered for the lead role of turnkey and financing for MRT Line 3 with longtime partner MMC and the rail systems and signalling firm George Kent. Now, Gamuda are gunning for all three major infrastructure projects slated for 2018, i.e. MRT3, the KL Singapore High-Speed Rail and the East Coast Rail Link. And just winning one of those three projects will be a mega multi-billion ringgit job for them. Today, the shares are down 0.2% to 5 ringgit 24 cents, but they're still up 5% in the past month alone and booking an 8% one-year return. Now, RHB reckons that while Gamuda has done well to secure the financing for the project, they're not likely to enjoy the same 3.25% soft loan that the East Coast Rail Link project got, and more likely will be between the 10-year MGS rate of 3.9% and quasi-government bond rates of 4.5%. RHB Research are upbeat on Gamuda's prospects, saying they have a reasonable chance in securing at least one of the three major infrastructure projects. Hence, they maintain a buy rating and a sum of parts target price of 5 ringgit and 80 cents. Ireka Corp Berhad. Now, Ireka are an infrastructure and real estate company that are also an online auction operator and a technology venture capitalist. Now, they've been really busy. They've teamed up with China-based CRRC Group and STO Express to look into expanding the logistics business areas in Malaysia and Southeast Asia, which would include logistics warehouses, distribution centres and real estate. Also, their 23% owned associate company, Asiana Properties, plans to sell all its properties currently worth $180 million in stages to generate returns for their shareholders and parent company. Today, Ireka shares are down 2% to 77.5 cents, but they're still up 22% in the past month alone and recording a 23% one-year return. It's early days yet, but some factors will militate against Ireka, like fierce foreign, even local competition, thin margins of commercial viability. But the money from selling Asiana will give them a good war chest, and the wall of investment from China's Belt Road Initiative will be big for everybody. Now, Ireka remains a tiny company, relatively speaking, with a market cap of 147 million ringgit, so no analyst coverage. But with CRRC, one of China's largest rolling stock companies, i.e. Trains, taking a 9.3% stake in Ireka at just 58 cents a share, Ireka bears watching in the years ahead.